Gold is having a golden run. Over the last 1 month, as of 19th April, it has gone up by about 12%, while Nifty 50 has gained just 1.5%. Now, over the 6 and 3 months also, it's ahead of the Nifty 50 by about 15% and 9%. And although it has lagged Nifty 50 in 1 year returns, it has given it a tough fight. Now, the shining performance by the yellow metal has put it in focus of almost every investor. And many are wondering if they should invest in gold now. This video is about that and more. While we will try to answer this question, we will answer an even more important question. And that is, what should be the strategy for gold in your portfolio? Hello and welcome to ET Money's YouTube channel. In this video, we will talk about 3 things. First, what moves gold prices and what factors are responsible for the current rally in gold. This can help you assess where gold is headed. Number 2, what impact does gold have on your portfolio's performance? And number 3, what is the best approach to investing in gold? Should you do lump sum, have an SIP, or buy it tactically? Let me also tell you beforehand what this video doesn't have. We are not going to talk about different ways you can invest in gold. If you would like to learn about that, we have a video for that on another YouTube channel, 5 Minute Finance. You can watch this video for more information and also subscribe to this YouTube channel. And as you may already know, we also have a Hindi channel जहाँ पे आप ये सारी videos हिंदी में देख सकते हैं. I've included the links of the 5 Minute Finance and the Hindi channels in the description, so do take a look. Okay, let's start with understanding what moves gold prices and which of the factors are responsible for the current bull run. As someone who wants to have gold as part of their portfolio, it's important for you to understand what moves gold prices and which of the factors are in play at the moment. This can help you assess where gold is headed. Now, while a number of factors can have a bearing on the gold, the most prominent ones are: number 1, supply and demand; number 2, inflation and interest rates; number 3, US dollar rates; and number 4, geopolitical factors. Let's understand these factors in greater detail and also try to understand which ones are responsible for the ongoing bull run in gold. Let's start with the supply and demand factor first. For this, we looked at, well, the demand and supply of gold. Now, this data is available on the World Gold Council's website, so you can check it anytime as well. As you can see, the demand for gold has gone up from about 4,000 tons in 2021 to close to 4,400 tons in 2023. Now, the demand for gold majorly originates from 4 avenues: jewelry fabrication, technology, investments, and central banks. Of these, while jewelry fabrication is the largest contributor, it's the demand from the central banks that have shown the biggest jump, rising from 450 tons to 1,037 tons over the last 3 years. Now, the demand from the rest of the avenues have remained more or less constant. Now, the rising demand from central banks is a reflection of the tough geopolitical conditions about which we will talk shortly. Now, on the supply side, while there have not been much changes at the aggregate level, the supply has been more than adequate to absorb demand. For instance, the total demand in 2023 was 4,448 tons and the total supply was 4,899 tons. So, in aggregate, the supply-demand trends appear balanced. Alright. The next factor is inflation and interest rates. A rising inflation often fuels the demand for gold as it is seen as a hedge against inflation. However, the story changes when the interest rates go up. Gold prices are believed to have a negative correlation with interest rates. What that means is that when interest rates rise, gold prices fall. Now, another way to see this is that when investors can make higher returns in fixed income, they tend to move out of gold. Now, between 2022 and 2024, the US interest rates rose from 1% to 5.5%. Now, surprisingly, during this time, gold prices also went up. So it seems some other stronger tailwinds pushed gold prices upwards. Now, lately, the US Fed chairman hinted the delayed rate cuts amid high inflation. This should have dented gold prices, but it didn't happen. Another factor that affects gold prices is the US dollar. Because international gold is denominated in dollars, any weakness in the dollar results in higher gold prices. But if we see the recent movement of the US dollar index, it has actually moved up. So theoretically, the gold prices should have fallen. In reality, they have also raised. So what's going on? Well, the answer lies in the remaining factor that influences gold prices, which is geopolitical factors. Gold benefits from geopolitical tensions as the trust deficit in the global economy increases. Now, the last couple of years, 2 major wars have broken out between Russia, Ukraine, and more recently between Israel and Hamas. The Israel-Hamas war seems to be escalating with newer actors like Iran getting into the fray. These political tensions have also resulted in the central banks increasing their gold purchases. The Russian and Chinese central banks are especially at the forefront of this. Combined with this are the upcoming elections in the US and the increasing Chinese aggression towards Taiwan. Now, in the absence of other stimuli, it seems like the geopolitical tensions are the major driver of the ongoing gold rally. If the tension escalates, so will gold prices. But it appears to be more a sentiment-driven rally than a fundamentals-driven one. So as a gold investor, you must keep this in mind. While at the moment it seems a remote possibility, but any stalemate, de-escalation or truce can quickly puncture the gold rally. And since other drivers of gold, supply demand, interest rates and the USD movement don't seem to be conducive to gold prices currently, that can make the fall even steeper. So it may be time to be cautious. Now this brings us to the next section, how gold affects your portfolio's performance. But before that, let me request you to subscribe to this channel if you aren't already a subscriber. And don't forget to click on the bell icon so you never miss a video from us. And please do like, share and comment so that this video reaches far and wide and benefits many more investors. Okay, the question that we will now try to answer is how gold allocation affects your portfolio's performance. Now, many investment advisors recommend a gold allocation of about 10% in the portfolio. They say that gold can be hedged against inflation, and often when equity and debt fail to perform, gold does well. But they also caution against too much gold in the portfolio as it is an unproductive asset. It has limited practical usages as such and is just hoarded for its perceived value. And many of us would remember Warren Buffett's famous quote on gold. So while the run-ups in the gold continue to surprise the more logical investors, the fundamental nature of gold itself makes it difficult for them to see it as an investment. That's why perhaps the middle path is to allocate 10% or so in gold so that you don't experience FOMO. Neither do you ruin your portfolio if gold doesn't work. So the question of how gold impacts your portfolio performance has a sub-question too. If it does, then how much gold should you have in your portfolio? Let's first see the impact of a more acceptable 10% allocation to gold on a portfolio. Let's compare the performance of a 60-40 portfolio with that of a 60-30-10 portfolio. 60-40 means 60% equity and 40% debt. And 60-30-10 means 60% equity, 30% debt and 10% gold. Now for equity, we have considered the Nifty 50 TRI. For debt, ISEX Sovereign Bond Index, and for gold, Nippon India Gold ETF. Now, SIPs of 20,000 were done in these portfolios every month from April 2014 to April 2024. The portfolios were rebalanced in April each year to restore the asset allocation. Now, the portfolio that had 10% gold did better than the portfolio that had only stocks and debt. The 60-30-10 portfolio accumulated 45.81 lakhs and the 60-40 portfolio yielded a corpus of 44.51 lakh. But this is half the picture. We also need to check the drawdowns in these portfolios to see if having gold has any tangible benefit in terms of downside protection. For our purposes, a drawdown is a fall in the portfolio value from its previous high. The greater the fall, the greater the drawdown. The table shows the top 10 drawdowns of the 60-40 portfolio and the corresponding drawdowns in the 60-30-10 portfolio. For example, in 2020, amid the COVID-19 led crash, the 60-40 portfolio fell by over 13% from its previous high. On the other hand, the 60-30-10 portfolio fell less than by 12%. In rupee terms, the 60-40 portfolio lost 2.45 lakh. On the other hand, the 60-30-10 portfolio lost about 2.19 lakh. That's a difference of over 26,000. And not just this, on most occasions except one, the 60-30-10 portfolio did better than the 60-40 portfolio. Not only did this portfolio deliver better overall returns, but it also contained downsides better. This suggests that there is indeed a case for gold allocation in a portfolio. But what if we increase the gold allocation to say 20%? Well, the end value is even higher with the 60-20-20 portfolio. As against the 45.8 lakh generated in the 60-30-10 portfolio, the 60-20-20 portfolio delivered a corpus of over 47 lakh. But what about the drawdowns? Well, the drawdowns also were less in all cases except one in the 60-20-20 portfolio. If we again take the example of the COVID-19 led crash, the 60-30-10 portfolio lost 2.19 lakh from its previous high. On the other hand, The 60-20-20 portfolio lost just 1.93 lakh. That's about 26,000 less. In percentage terms, the 60-30-10 portfolio suffered a drawdown of about 12%. The 60-20-20 portfolio limited its drawdown to 10.3%. So, more gold in the portfolio seems to have improved the portfolio performance. But if gold can be a worthy component in a portfolio, why not have more of it? Maybe a 30 or even 50% allocation? That's a good question and we will try to answer it soon. But before that, let's move to the next section. How you should invest in gold. So what's the best way to invest in gold? You can invest in gold via lump sums or SIPs or tactically. Let's assess each of these methods. As far as SIP versus lump sum returns are concerned, SIPs seem to have edged as of now. They have done better than lump sums across 3, 7 and 10 year periods. The other point to be noticed is that in absolute terms, the returns appear to be quite handsome. But both these types of returns are heavily influenced by the recent run-up in gold over the last couple of years. If we see the 10-year returns across periods, the situation changes. Now, lump sums have done better than SIPs in 4 out of 6 cases. But the more notable thing is the returns have significantly tapered. There have been 10-year periods like 2008 to 2018 and 2009 to 2019 where SIPs returned just 5% and 3.4% respectively. Even lump sums haven't done very well with returns of 9% and 6.5% only. This pattern repeats itself through the other 10-year periods also. Let's take a look at the average rolling returns from gold to get a better idea of performance across periods. To find average rolling returns, all return instances over a period were averaged. For instance, if it's a 5-year rolling returns, then all 5-year periods are taken and their returns are averaged. So in essence, rolling returns are the equivalent of the average returns an investor would have got had he invested for any specified period between 2 dates. The same pattern repeats here. Across long-term periods like 5, 7 and 10 years, gold's performance has been rather dismal, with returns ranging from 7 to 8% only. That's a far cry from what gold has delivered lately. Now, all this suggests that gold has become the hero that is today quite lately. A look at Nippon India Gold ETF's NAV chart can help understand this. As seen in the chart, gold rallied from 2008 to 2012, it was then range bound from 2012 to 2019, and since 2019-20, it has found fresh momentum. So since for a very long time between 2012 and 2019, gold was range bound, the returns from this period were rather capped. Of course, there have been rises and falls during this time, but for someone who invested at the start of 2012 and stayed invested until 2019, it might have been a huge opportunity cost. But what explains this? Well, the answer lies in what we discussed at the start of the video, the drivers of gold prices. Most of the drivers are related to economic or geopolitical factors. There are supply and demand factors also, but gold tends to react more sharply to economic and geopolitical factors. So it wouldn't be wrong to say that gold may be a hedge against inflation, but is more a hedge against uncertainty, be it economic or political. And that's what gives it relevance. When the world order seems to be crumbling, the obvious thing for both lay people and central banks to do is to seek shelter in gold. And this is not a recent phenomena. Since the start of human civilization, gold has been held in high regards. And whether it's logical or not, in all likelihood, gold will continue to enjoy that status. Given that its relevance is better highlighted during crisis as an investment, gold will also remain more of a tactical play rather than a buy and hold asset. So, to profit from gold, you will need to keep an eye on its drivers and invest and exit gold based on them. And this answers the question we mentioned a little earlier. Why not have more gold in your portfolio? You can of course have more gold, but to get more out of it, you should be able to enter and exit it tactically. And this is what we had for today. I hope you found it video useful, and if you did, please share it with your friends and family. I'll be back soon with another video. Till then, take care.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.